Welcome to Taking Stock for the week ending the 19th of August 2022. I'm Kien, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Well, it's such a busy time with the reporting season, but really appreciate you coming on board, Matt.
Not a problem at all. Thanks for having me, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. Well, we are midway through the Australian reporting season, and so far, results have fared better than expected, with 71% of companies meeting or beating market expectations. And although inflationary cost pressures remain the dominant theme, many high-quality companies have been able to sustain their profit margins by raising prices or improving cost efficiencies. And this has resulted in the trend in forecast earnings for the market over the last 3 weeks. That's been relatively stable.
It has, Kien, and the positive reporting season has really helped sustain this rally, with the All Ordinaries Index rising over 11% since its lows in mid-June. But with the earnings holding up as well as they have, the latest rally hasn't really made much of a difference to the relative valuation of the market, with the market price to earnings multiple continuing to trade below its historical average of about 15 times. Now, investors do remain nervous and appear to be anticipating a slowdown in both economic growth and corporate earnings. But with the unemployment rate at lows of about 3.4% and banks actually reporting a decline in bad debts, the economy to this point appears to be holding up and remains quite resilient.
Yeah, Matt, and with a resilient economy, the reporting season is a great time for investors to confirm the quality of those businesses with the release of their results. And with many companies trading at attractive valuations, investors may want to take advantage of numerous oversold opportunities across both star growth and income stocks. And you can use our Stock Doctor filter to identify these opportunities by sorting a list of all-star stocks in order by either their 6-month price change or also the price to consensus price target as well.
And earlier this week, we had regional bank and star income stock Bendigo and Adelaide Bank release its FY22 annual result, which on the surface did appear in line with expectations. And despite the fact that the bank actually posted a 14% lift in earnings, the stock was sold down by about 12% over the next 2 days. And the reason for the price pressure was due to the company's commentary on their outlook, which underwhelmed investors.
Yeah, Bendigo, they guided for only a modest improvement in net interest margins and cited competitive pressures and funding costs as the limiting factor. In addition, they do anticipate a slowdown in their lending book as borrowers shy away from rising interest rates. Despite this, we have retained Bendigo as a star income stock due to its attractive above-market financial year 23 dividend yield of around 7.9% with an unstretched payout ratio of 66%. And the share price weakness could represent opportunity for income investors, given that the stock is expected to go ex-dividend on the 5th of September 2022.
And unfortunately, another company which disappointed investors was oil and gas producer and star growth stock Beach Energy. Although it has been a good year and their earnings grew by 77% over the previous period, and which led to a 22% return on invested capital, the company was hit with higher than expected costs, which has been a theme that we have been discussing most recently. And in addition to that, its production guidance for only flat growth was about 8% below analyst expectations. So with a downgrade to earnings expected over the next 12 months, I'll posit the question to you, Kien. Why have you and the research team retained the stock in the coverage list?
I know, it's interesting because it's been a very tight market in terms of energy prices. You know, the growth outlook remains fairly favorable, as you can see on Stock Doctor, although investors need to be mindful that this stock has earnings which is highly dependent on where oil and gas prices go in the coming year. But still, you've got elevated energy prices. But also, speaking about rising costs, building materials company and star growth stock James Hardie, they narrowed their earnings guidance downwards by about 3% on the back of inflationary cost pressures, also lower European activity, as well as the strengthening US dollar and housing market uncertainty caused by rising interest rates.
Yeah, so on the surface, it appeared like a downgrade, but the share price reaction on the result was fairly muted because consensus estimates for their full year earnings was already modelling in these cost pressures. So in other words, the market was largely anticipating the company to downgrade their full year earnings expectations. And that said, earnings growth is still expected to be greater than 20% for the year. So we certainly haven't entered a disaster territory by any measure for this business. And in addition to that, the share price appears to have reflected much of the risks, with the stock having already declined from a high of $57 in December 2021. So the share price weakness could potentially represent an ideal entry point for investors who fully understand the active risks, including management transition and rising interest rate impacts to building activity.
And meanwhile, a key market heavyweight, borderline star growth stock and star income stock BHP, they managed to defy market expectations by increasing their full-year dividend by 8%, despite reporting rising capital expenditure and also reserving capital for acquisitions such as the copper miner Oz Minerals. And this was a stark contrast to Rio Tinto, who had to reduce their dividend, Matt.
Yeah, BHP are quickly becoming the market darling and the dividend king, aren't they, Kien? But look, they've managed to be able to do this through improved balance sheet, through its divestment of petroleum and some coal assets, which provides them with more freedom, obviously, to return capital to shareholders. And unlike Rio Tinto, where earnings are driven largely by iron ore prices, BHP was able to increase its free cash flow on the back of the stronger coal price environment that we've experienced over the year. So couple that with the fact that there's $17 billion on the balance sheet in cash, the company was able to surprise investors by paying a final dividend of 247 cents per share. This translates to a gross dividend yield of a whopping 15%, with the stock going ex-dividend in early September.
And a star stock that has been on our radar for a while now is metal detector and communications equipment manufacturer Codan. Positively, the company met market expectations, with revenue growth supported by its prior acquisitions of communications companies, DTC and also Zetron, which are performing well. However, the civil unrest in Sudan, Africa, continues to present challenges to the company, with management guiding for a weaker than expected recovery in metals detection, the business, in financial year 23. And this segment represents around 26% of their total revenue. The expected decline, with its return on equity falling from 35% to 31%, suggests that the stock could be removed potentially from our borderline star growth stock coverage.
And there have been a host of other results this week, haven't there, Kien, that we haven't mentioned in this result, as the analysts are still trawling through the finer details. These include ASX, Pro Medicus, Medibank Private, Brambles and CSL, and I'm sure we'll endeavour to talk through those in a little bit more detail in next week's Taking Stock. But for me, quite quickly, the pick of the bunch was Pro Medicus once again. I listened to the earnings call yesterday, and that runway for growth continues to expand for this business. It was an excellent result. And looking at the week ahead, our corporate calendar tells us that we have a very busy week ahead of us again, with star stocks reporting, including Altium, ARB Corp, Breville, Domino's Pizza, IDP Education and Wesfarmers.
In Under the Microscope this week, we take a close look at automotive parts retailer and star income stock GUD Holdings. Remember, the company's financial result was in line with market expectations, and management's recently downgraded profit guidance in June.
Correct. And that downgrade did relate to supply chain constraints, slowing down the release of new vehicle sales, and this has impacted revenue for its automotive parts business. But with all that said, with all that having been pre-announced, Ken, before the result, are you able to provide some further explanation as to why we are only now removing the stock from the borderline star growth universe?
Yes, Matt. If you can recall, in December 2021, the company made a material acquisition of Auto Pacific Group, which was funded by $405 million in an equity raising. And although the deal helped the company generate earnings growth of around 9%, despite the supply chain challenges, it's also led to a dilution of its return on equity from 17.8% to 14.4%. And the declining return on equity is also above our allowance. And so we've had to remove the stock from our Boardline Star Growth stock universe.
Yeah, that's a fair point there. But from an income point of view, the final dividend of 22 cents declined from the 32 cents per share that they delivered the year previous. However, the reduced dividend reflects the additional shares that were issued as part of the capital raise in December 2021. As such, the decline doesn't reflect anything ominous.
Yeah, that's right, Matt. Although they did cut their dividend, the outlook is still quite positive for dividends, with dividends expected to lift to around 52 cents per share. And that's supported by an unstretched ratio of 60% and a strong growth also in free cash flows as well. The outlook appears positive, with increasing demand from the aftermarket service providers. And also they are planning to increase their prices as well. With an attractive gross dividend yield of around 8.5%, we have then retained its star income stock status. The stock goes ex-dividend on the 26th of August as well.
Yeah, so a few investors may be wondering whether these heightened risks around the lack of new vehicle supply could continue to impact the business. So management has suggested that these supply chain constraints are moderating, but remained heightened relative to historical risks. Positively, though, the revenue is not expected to be lost, but rather delayed, with the dealer order books still at record levels. So hence the market anticipates a strong recovery in FY23 and beyond.
But the stock was sold down heavily following its earnings downgrade in June, and is now trading at a steep discount to its consensus price target. Hence, we believe the risk to reward is more balanced at these levels, although trend-sensitive investors should remain on the sidelines until an entry point is triggered on the SD30 TSR or the SD Max. And now, with reporting season and announcements and star stock updates released on a daily basis, a useful question for clients is, how can they keep track of all the star stock changes during the reporting season? So to keep track of the star stock updates and company announcements, clients can refer to the latest star stock update section under the research homepage.
And to get more detail, click on View All, and this will take you to the recent updates and announcements page. You can also access the page under the Tools header and clicking on Recent Updates. Here you'll be able to monitor star stock recommendation changes by selecting all companies. Choose a time frame, say 3 months, and then select star stock recommendation changes. The tool will then provide you with a list of all star stock changes.
Note also that you can also identify star stocks that have experienced a change in the consensus price target or forecast earnings revisions there too. This is quite useful to understand whether analysts have been upgrading or downgrading their outlook on the stock following its results. But it's probably also more useful to go to the alert manager and set up the earnings estimate or price change alerts, which allows you to enter in a percentage threshold and be alerted via email. And you can also enable analyst comments and daily digest email notifications through your notifications settings. Well, that's all we have time for today. And thanks again. I know you are very busy, Matt, with the reporting season, analysing results for the funds, but really glad for your wonderful insights today.
No, thanks for having me. And busy is good when earnings are as strong as they have been. So long may the rally continue, Kien.
Yeah, hopefully. And also with reporting season, it may be useful for you to attend our Lincoln Live webinar on Monday, where we talk about market strategies and answer your questions on stocks. So to summarize, reporting season has turned out better than expected, with 71% of companies meeting or beating expectations. And even though the market has rallied strongly over the last few weeks, there are still star stocks which remain oversold and could represent opportunity once they confirm their compelling set of numbers. Make sure you take advantage of Stock Doctor to keep track of star stock changes and announcements. Take care and have a happy, healthy, and prosperous week, everyone.